Coming to the second part of economics, so this is a subject which is almost has around 10% weightage for CFA level 1. Now the reason why they are teaching you economics is because from an investment point of view it is very important to understand the macro picture or the micro picture of a specific industry or a country before investing. So let's get into the details of it. So this is what the definition of economics is given by Adam Smith. So he says that economics is the study of nature and uses of national wealth. So Adam Smith is basically the father of economics. Now let's get into the details as to why he gave that definition. Now macro and microeconomics, what is the difference? So for example, today I am an investor in the US, right? And I would like to invest into various companies. So I am looking for, let's say I'm looking at companies in India, I'm looking for companies into China and the US itself. But before I jump into any companies into India, China, or let's say US, I need to understand at the macro level how are the countries growing, so that I can filter out and I can come into the specific industries or specific companies in the specific country that we're talking about. So for example, India is growing at a GDP of 7%, let's say China is growing at 5%, and let's say US is growing at 2%. So it's pretty clear that India is growing at a faster rate, right, than China, and China is growing maybe higher than the US. So can I now, so now it's clear that okay, India is growing pretty fast, so can I now get into a specific sector? So then I would come into India and then try to explore sectors. So it might be auto, which is automobiles, then I could come to IT sector, I could also come into, let's say, the service sector, or even steel, etc. So then I would come into auto and then I would try to see that okay, out of, let's say I understand that India is growing at 7%. Now let's see where the major contribution of growth is coming. So for illustration purpose, let's say I'm saying that the auto sector is growing at 6%, the IT growth is growing at 10%, let's say the service is growing at 5%, and let's say the steel is also growing at 10%. So now I find out that okay, out of these all sectors, IT and steel are doing good. So now let's come to specific companies, right? So in specific companies I could look at, let's say, another 3 to 4 companies I could identify. For example, if you want to take about IT, then you could talk about Infosys, right? If you want to talk about, let's say, steel, I could talk about Tata Steel. Or again, in IT company, if I want to identify smaller companies like Hexaware, right? So that's how basically the macro economics works, and ultimately you come to the specific companies, which is for example, here we took an example of Infosys, Hexaware, and Tata Steel. So that's the reason why you discuss macroeconomics. So at a global level, at a very macro picture, you get as to how the specific industries are working. Now microeconomics is again now talking about the economics of a company. So for example, if you are running a company and let's say you are manufacturing automobiles, right? So now you would like to understand that if your plant capacity is, let's say, producing 1000 vehicles, right? So what is the maximum optimum level can I produce to be profitable, right? So that could be a question that you could answer in microeconomics. So the definition is given here. So macroeconomics says the study of big picture issues in an economy, including competitive behavior among firms, the effect of government policies, and overall resource allocation. Now when they talk about government policies, right, so you can bring your attention to agriculture in India. So agriculture basically has no tax. That's a policy of the government to promote agriculture, right? Microeconomics, as we already discussed, so right, how much to produce, or rate at which to sell, etc. So those are microeconomics issues that you try to answer. Now we're talking about policy, then there are two kinds of policy. One is monetary policy, right, which relates to banking sector, majorly banking sector, right? So that's where the RBI comes into the picture. So everything related to banking and interest rates, RBI takes care of it. All the other policies like taxation, subsidy, right, even the recent demonetization, right, all related to finance except the banking is taken care by the fiscal policy, right? So if you might even remember that the long-term capital gain tax, so if you invest into stocks today, and let's say if you hold it for a year, right, so if you hold a stock of a company for a year, yeah, so then if whatever gain you make during this period is no tax. So that's a policy to promote savings or investing into stocks. Also, if you see the current limit, so if you invest 2,50,000 into ELSS, right, so then you can claim exemption for 2,50,000 of your income, so you pay lesser taxes. So that's again a policy related to the fiscal department. So this is basically headed in India by Arun Jaitley, and the RBI is headed by Urjit Patel. So let's talk about monetary policy. So types of monetary policies. So there is an expansionary monetary policy, which basically the RBI tries to focus on speeding up the economy or increasing the economic growth, right? And there is another policy which is contractionary, where you want to slow down the economy, right? Now obviously the question is why you want to slow down. It might so happen that inflation has gone up, right? So what inflation basically means is that if today you have 100 rupees and you are buying 100 rupees worth of goods, maybe on the second year you might only be able to buy 80 rupees worth of goods. So that's inflation. So your value of money has deteriorated, right? So that would require the RBI to take contractionary monetary policy to slow down the inflation. As we already discussed, that's the one of the policies where RBI functions. Expansionary, it might so happen that the inflation is very low, but the economy is also growing very slowly. So it might so happen that RBI may take some measures by which the economy really boosts up, right? So these are two types of monetary policies. Now let's take for Richies case. So Abhishek Jain has planned, after a decent start of the business which we saw, now to renovate the restaurant to add the capacity of 50 customers. That's what he wants to do. So he wants to basically add capacity in his restaurant. Now if he wants to do that, he would need an investment of 25 lakhs, right? Now in order to get this 25 lakhs, he needs a loan, right? So this is the case. Now what has happened is, if RBI takes the growth path, which let's say he is doing an expansionary policy, so it will lower the interest rates. So if it lowers the interest rates, bank lower the interest rates, and thus what happens is Richie can probably raise 25 lakhs easily. Probably if the interest rate, let's say we are assuming that it is from let's say 9%, it comes down to 6%, right? So basically what's happening is Now since he is able to take this investment, so now he's again investing in the economy, hence the spending has increased, and hence it will aid to the growth of the country. Similarly, now let's say RBI has come into the inflation control mode, so it will hike the interest rate. So for example, from 9% it might make it 11%. So consequently the banks will increase the interest rates, and Richie might have to reduce the loan amount from 25 lakhs to maybe 20 lakhs. So partially the RBI was able to decrease the spending, and hence if the spending has decreased, then the growth has reduced. If the growth has reduced, the inflation has reduced. Now let's try to understand an example of microeconomics. Now we understood the macroeconomics as to how the big picture turns out to be the expansionary monetary policy and the contractionary monetary policy. Right, now let's try to understand from the business perspective of how economics actually helps you in understanding the business scenarios. For example, in this case, let's understand that Abhishek wants to understand the elasticity of his business. So what does elasticity mean? What elasticity means is, let's say I have put in some data here. So this is hypothetical data in case of Abhishek, but he just wants to try it out and try to understand how does the demand for his coffee per hour change if he changes his price. Alright, so in this case, let's consider scenario A, and in scenario A, if you see, the price of a cup of coffee is 250, right? So if he keeps the price at 250, then the quantity which is demanded is around 4, right? If he changes to 240, reduces to 40, the quantity increases to 5, and so on. It keeps happening till 100, right? So at 100, the quantity demanded increases to around 12. Now what exactly does this mean? So how do we quantify this, right? Do we just directly decrease the price to 100, or do we do some analysis to understand the elasticity of the business? So elasticity, as the name suggests, is like an elastic, right? So try to understand the analogy. If it is elastic, right, so you can pull it, right? If it is not elastic, then it is stiff, right? So you cannot extend this, right? So if your elasticity, if your business is elastic, that means that the change in price will have a change in demand. And if it is inelastic, then your change in price basically does not change your quantity demanded. So there are a lot of examples in the real life. If you see, for example, there are life-saving drugs, right? In that case, if you change the price, it's not going to happen that life-saving drugs are going to get demanded more, right? Or if you decrease the price, it's not going to happen that the amount of quantity demanded is going to increase, right? So that's what we mean by elasticity. So in this case, I have put it down on Excel. So if you see, this side is your price and this side is your quantity demanded, right? And that's how the graph gets made, right? So now we want to understand and calculate a quantifiable number which will be able to tell us that along this line, right, at various points like A, B, C, D, E, F, what is the elasticity of demand, right? So what is the basic formula for elasticity? So elasticity is calculated as percentage change in quantity divided by percentage change in price, right? So the reason why we are taking percentage change in quantity is because these numbers do not have a unit, right? Hence we are using percentage change divided by percentage change. So both are percentages, and hence it will not be affected by demand because it will be similar on the upwards and the downwards side. So let's try to calculate that, right? So let's open our Excel sheet. So for the reference purpose, I've already put in the numbers here. So I have created a demand schedule, I have scenario, A, B, C, D, E, F, price, quantity, and now I'm going to find out the percentage change in quantity. So what I'm going to do is percentage change, so we're going to go downwards. So it's going to be 4 minus 2. Now in contrast to calculating 4 minus 2 divided by 2 to find the percentage change in quantity, just because we want to keep things pretty similar even if we go upwards, so we find the average of 2 and 4, right? So that's your percentage change in quantity. Similarly, I can find the percentage change in price, which will be 235 minus 250 divided by average of 250 to 235, right? So that's my percentage change in price, so which comes out to be obviously a negative number. Now my elasticity formula is percentage change in quantity divided by percentage change in price, right? So if you see, this is a higher number, so in this case let's just copy this and see it till here. So if you see, the elasticity keeps on decreasing. We can also take an absolute number, so we can get rid of the negative sign and we can see it in absolute terms. So you can just write it at ABS and select the number, so it'll give you a positive number, right? So this is the positive number. Now if you see, as and when the price changes from 250 to 235, since the base is higher, right, and if you see, the percentage change in price is also pretty high, right, and hence the elasticity is higher in the upper curve. And as and when I start decreasing the prices more and more, the base becomes smaller and the percentage change in quantity decreases, right, and hence the elasticity also becomes starts decreasing. Now if your elasticity is less than 1, we call it very less elastic, and in this case when your elasticity is greater than 1, we call it very elastic. So that's what the understanding of the business would be, that how much to change the price to, and that's where the economics becomes pretty important to understand the industry. And in this case, Abhishek Jain would be able to understand that, see, even if you cut your prices from 250 to 190, right, your elasticity ultimately will decrease, and hence it wouldn't be that useful to cut the prices from 250 to 190. In other case, if he is decreasing from 250 to 235, he's getting a lot of changes, right? So his demand increases significantly, but he keeps doing that and it becomes inelastic, right? So that's what a simple example of microeconomics concept that is taught at CFA level 1. If you are able to understand it this way, then the concept is pretty simple. If you just do it from the perspective of a formula, then things will never be as interesting as you can make it this way. Moving on to quantitative methods. So quantitative methods is something similar to mathematics of finance, right? And it holds of good value at level 1, close to around 10 to 15%, and nothing to be really scared about in quantitative methods. In the CFA level 1 syllabus, you are allowed to use a BA2 plus calculator. So every calculation happens on a calculator, and hence no manual calculations is actually required. Although the calculator is required, but certain methods have to be learned as to how to operate this. We won't really be going into how to operate the calculator, but I will be going through some calculative questions so that you understand what kind of maths is entire quant about in CFA level 1. So let's get started. First of all, why is this subject there at the first place in the CFA level 1 syllabus? So let's understand that. First of all, you understand that CFA by now, that CFA is talking about investments, right? So CFA syllabus is entirely about investments. Now if the entire subject is on investments, then we are also trying to calculate a return right? So if I say that I have equity, gold, silver, real estate, fixed deposit, I should be able to calculate different kinds of returns for the asset, right? Which is of prime importance. The second thing is you also need to understand the past performance of an asset. For example, let me just draw a graph. So if you consider equity, so equities go up, they go down, they go up, they go down, right? So how do I understand this performance, right? So you need statistical techniques by which you are able to analyze these graphs, analyze the performance, correct? Also you need to understand the risk. So if I draw a graph in this way, how can you quantify this in terms of risk, right? So concepts like standard deviation, drawdown, right, are taught at CFA level 1. Also comparing investments. So if I say that there is a mutual fund A and there is a mutual fund B, then how do I compare them? There has to be a common metric according to which I am able to compare mutual fund A and mutual fund B. Just to give you a heads up, what is a mutual fund? So if you do not understand what is a mutual fund, so people come together, they pool in their money and they give it to a fund manager to manage into either equities, bonds, ETFs, whatever, right, depending upon which asset you want to invest in. So mutual fund A, mutual fund B, let's say they're in the same category of equities, right? Now if one person is one mutual fund A is saying that the return is around 15% and mutual fund B is saying the return is 12%, right? But I can't really make my decision based on just these numbers, right? So there has to be some other numbers which has to follow. So let's say I say the standard deviation of 15% is around 30, right? Whereas for 12% the standard deviation is, let's say, around 15%. So now you are able to make some metric according to which you are able to compare investments. So there are concepts like Sharpe, right? So Sharpe ratio is basically you are trying to understand that for each percent, so this is the risk, right, and this is the return. So you want to understand that for every percent of risk that you're taking, how much return am I getting? So in other words, I can put this as 15% minus whatever returns I can generate without taking any risk. So that is around 7%, which is the fixed deposit rate or the risk-free rate, and I divided by standard deviation. So now I know there is a metric according to which I can understand the risk and return parameter. So even those are covered in Quant, right? So now we understand why basically Quant has been put up in the CFA level 1 syllabus in the first place. Now let's get started by discussing on the concept of time value of money. Now as the name suggests, there is time, there is value, and there is money, right? So just to take a simple example on this timeline, so we are standing here, right, and we want to talk about here. So if I say that today I have 100 rupees, considering that I am not going to invest anything, right, considering that I am not going to generate any returns in this 5 years, would you say that the value of 100 rupees will be 100 here, right? Obviously not, because there are factors like inflation, right? So inflation basically means that it has a certain rate, like let's say 3%, which basically means that the value of money decreases by 3% year on year. Alright, and hence the value of 100 rupees today will not be 100 at the end of 5 years. We are not talking about the denomination of the currency, we're just talking about the purchasing power of the currency, right? We're not talking about the denomination. 100 rupees note will still be 100 rupee note, but the purchasing power of it will reduce, right? In the same way, you could increase the purchasing power of your money by compounding it. Here your money value is deteriorating. So if your money is kept in your house,
there is no return getting generated on the 5 years. Hence your value of money will deteriorate. On the other side, if I am able to invest it above the inflation rate, so let's say if inflation is 3% and I am able to generate 5% year on year, then the value of money is going to increase, and hence the purchasing power will be much higher at the end of 5 years, right? So that's what the concept of time value of money is, right? Now let's go a little bit ahead and try to build on this. So let's say today, so this is 0, this is 5, and I say that I have 100 rupees which is invested. In time value of money nuances, this is called present value. Alright. Right. The rate at which the money gets deteriorated or gets appreciated is called the rate. So for example, I am able to generate 5% annual return, right? Then this is called rate in time value of money terms. Okay, now the value of money after 5 years that I'm going to get, if I compound it at 5% rate annually, then the value here, let's take an arbitrary figure that it is 200, let's say, then this is the future value. Alright, so you have present value, you have future value, you have 5% return. Also, the number of periods that I'm going to compound it for, right? So these are 5 years. So this is called N per, or in other words, number of periods. Correct? Also, I can add a little bit of complication in this timeline, and I say that along with 100 rupees that I'm going to invest initially at 0, okay, make sure you understand this clearly. Along with 100 rupees that I'm going to invest at 0, I'm also going to invest, let's say, 5 rupees year on year. Now you understand that this is reoccurring at the same rate. It's not becoming 5 and 10 in some other days. I'm just saying that equated numbers are going to get invested in at the end of every period, right? So this equated payments are called PMT. In other words, it is also called payment. Now the PMT, okay, now this is, we have talked about in terms of investments. All right, so you have your present value, you have your PMT, which is investing 5 rupees apart from 100 rupees that you're going to invest initially. You have the rate, which is the rate at which the money is going to get compounded. You also have the future value, which is 200 after 5 years, and number of periods you're going to compound it for 5. So this is in terms of an investment scenario. Now let's try to see it from a loan scenario. Let's say today I require 100 rupees loan, right? So I know that the present value of the loan is 100. Let's say the rate which is charged is 7% year on year interest, right? What will be the future value of this loan? Since loan is going to get repaid using EMI, hence the future value of a loan is always 0, right? I know the number of periods, so I know the N per in this case is 5. I know the rate, I know the PV, I know the FV. What I don't know is the EMI, equated monthly installments. Okay, so that again here falls into PMT. So in this case I'll have to find PMT. So basically what and the reason why I have taken two examples in this case is just to make you understand that you can just, if you have 1 2 3 4, you can find the fifth variable, any of them, right? In case of either investments, or you can also change this entire concept and ask that, okay, if my value of 100 rupees becomes 500, all right, in 5 years, right? So, and obviously I'm not investing anything apart from this, so PMT will be 0. So what is the rate? So I can find out the rate, which is the return. So instead, since I said that if you have 1 2 3 4 and fifth variable, which is PMT, so hence you can find out the other variable, right? So let's build on this. So these are the functions which are available. Now these functions are available easily on Excel: present value, future value, rate, NPER, PMT. You just type in is equal to PV in Excel and you would get the formula. So you don't really have to remember any formulas in this case. It is already shown on the Excel. So let's open up a Excel sheet. Okay, so I have my Excel open and let's look at some examples. So in this case we are again building on Abhishek Jain's coffee shop. So he has some requirements which he needs to fulfill. So we'll start from the second example. So he's saying that if I save 5,000 rupees every month, how much will I be able to save in the next 20 years for my daughter's marriage? So now understand that what does this mean? So this means PMT, right? Because it is equated and it is happening every month for the next 20 years, right? So for the next 20 years means how many periods do we have? So 20 into 12 months, right? So that's around 240 periods. Let's consider that the return that he is going to generate on this monthly is 1%. Okay, so that's the rate. So what do I need to find out on this? Also, I am not initially investing anything, right? So I'm going to, from next month I'm going to invest 5,000 every month. So my PV is equal to 0 in this case. So let's put this into Excel and try to find out. So in this case again, what is he asking? Is asking for future value. So just type in is equal to FV, open the bracket. So as I said, the rate monthly is 1%, the number of periods is 240, the PMT is 5,000. Now what you need to understand is that investment is always, when you're investing, it's always a negative cash flow because it is going out of your bank account, right? So I'm going to put in 5,000, PV is 0, and type is end of period. So end of every month we're going to invest. That's what is meant by the type. Alright, so that's 49, 46, 276 is what he'll be able to save in 20 years. Right. Next question. So he would be receiving 5 CR from his father after 10 years, assuming an inflation of 6%. What would be the current value? So he would be receiving 5 CR in 10 years. So I know the future value here. So I know the FV here. I know the NPER here. I know the annual inflation, so that's the rate. What do I need to find out? There is no PMT, so PMT is going to be 0. I need to find out the present value, right? So let's put in this into Excel. So it's going to receive 5 CR. So I'm going to put it into single decimal numbers just to keep things simple. So rate is 6% annual inflation rate as given. He would be receiving that in 10 years. PMT is 0 and the future value is 5 CR. So type 0. So it's 2.79 considering an inflation of 6%. So that's the value of the money, the purchasing power of the money that he will eventually get after 10 years is 2.79. Or also you could look at from the other perspective, that if he discounted this money to today's value, then the value of the money in today's terms would be 2.79, right? Let's build on. I had invested 5 lakhs in a property in 2000, so that's the year, and 2000. So that I know the number of periods, so that's 8 years, right? And he bought it at 5 lakhs, so I know the PV. I also know the future value, which is 25 lakhs. So how much return? So we're basically trying to ask rate. Again, in this case there is no PMT, so PMT is equal to 0. Okay, so they're asking for rate. So number of periods is 8, PMT is 0, minus 5 lakhs became 25 lakhs. Again, make sure you understand this. Investment is always negative, and what redemption you get post that is always positive. Type is 0. So 22% return was generated in his property. So you can, if you want to have a look properly, then you can look at this way, right? Next question, how many years will it take? So it's pretty evident what he's trying to ask. He's asking for number of periods. It will take for my investment of 1 lakh to become 15 lakh, assuming a rate of 15% annually, right? So we have the rate, we have the PV, we have the future value. What is asking for directly is N per, right? So let's just put that into Excel and try it out. So N per, so I know the rate, which is 15% annually. PMT is 0, PV is minus 1 lakh becomes 15 lakhs, and 0 is the type. So it's gonna take 19 years for the money to become 15 lakhs at a rate of 15%. So that's years. Now understand that you could just change the number of periods depending upon the questions. So if they are talking about monthly, then you need to multiply it with the number of months to increase the number of periods, right? If they talk about daily, then you need to multiply it with 365. If they talk about semi-annually, then you take 2 periods in a year. Now the last question is, I would be needing an additional coffee machine for 25 lakhs, assuming an interest rate of 13% annual and an EMI facility of 10 years. So this is a case when we will have to change some, convert some numbers into monthly rate, because EMI is always equated monthly installments. So if you're talking about 10 years, then how many months do we have? So we have 120 months. So my N per in this case will be 120. I also know the present value. Now in this case this is not an investment, so PV will be positive of 25 lakhs. I know the rate, so that's the rate. So what are they asking for? They're asking for the EMI. So let's calculate the EMI. So EMI is calculated using PMT function. So the rate I know is 13% annual. I need to make it monthly, so 13% divided by 12. Number of periods I know is 120. Present value of the loan I know is 25 lakhs. Future value of a loan, as I said, is already 0 and 0. So that would be the EMI monthly. Okay, 0.37 monthly. The reason why it's showing in negative is because I have taken the loan as positive, and hence the answer will come as negative, because when you're paying EMI, you're basically, it's a negative cash outflow, so it's negative. So these are basic examples of time value of money functions, very useful even in case of you calculating returns for your own funds and you're trying to make decisions. We can also build up into comparing projects or investments. Okay, so let's consider that Abhishek Jain has the option of building an additional branch in either two locations. One is near the highway and one is near the marketplace. So how does it decide? So I need to decide whether I should go ahead with this or I should go ahead with this. Right now, for starters, I have the same data, so both the places are going to cost me 1.5 crores. So how should I decide whether which one is better? So obviously that should be based on profitability. So let's consider that we made a simple model and we say that in the highway, these are my cash flows that I'm going to get. So if I build my additional branch on the highway, so my invest is going to be 1.5 crores and yearly profits are going to be this. Right? If in case I make it near the marketplace, then my investment is same, my profits are going to look in the same way. Obviously I need a quantification as to which one is better. So there's a concept of IRR. Okay, let's not get into the mathematics of what exactly IRR is, but what IRR will tell you is that if there is an investment of 1.5 crore and you get some positive cash flows of 50, 40, 30 and 50, so what is the return which is getting generated? That's it. And I can calculate the IRR for these cash flows and I can calculate the IRR for these cash flows and I can just make a comparison using a figure. So let's say if the IRR comes out to be 8% here and 9% here, so obviously 9% is better, right? So that's what the function of IRR is. The full form of IRR is internal rate of return. Right? So let's put these numbers into Excel and try to see what it looks like. Okay, so let's consider project A and I will put this as project B. So project A is the one which is near the highway and project B is near the marketplace. So these are my years, 4. So in project A and both the cases the investment is similar, so 1.5, 1.5, and after that I have 15 lakhs here, I have 40 lakhs here, I have 30 lakhs here, and I have 50 lakhs here. In case of project B, I have 15 lakhs here, I have 60 lakhs, then I have 30 lakhs, and I have 55 lakhs. So as I said, now we need to compare both of them. So I have a function called as IRR already in Excel. So you just type in is equal to IRR, open the brackets, and just select the values from beginning till the end, press enter. So I'm going to use the same formula and I'm going to copy it here. So if you compare both, your first investment, which is the project A, is basically giving you a negative return, whereas project B is giving you a positive return. So I am going to go with project B, which is near the marketplace. So that's the concept of internal rate of return. So IRR is useful when you have series of cash flows and you have one investment amount. So that cannot be found out using a time value of money function. Instead you can use IRR, which is much more simpler. Now let's take a live example of such a situation where you might have to calculate returns on a series of cash flows. You might be aware of that a concept called as systematic investment plan, wherein we invest into a mutual fund on a monthly basis. So let's consider that a person has invested 10,000 rupees from January 2008 to January 2014. So if he invests 10,000 rupees every month, he ends up investing total of 7,70,000 in the matter of 6 years, right? And let's say at the end of 2014 its value is 15,48,000. So how do I calculate returns on this, right? On a simple time value of money or function of rate, this cannot be found out because investment is happening every month. Alright, so hence what I need to use is I need to use a concept of IRR, or in other words I can use a much more sophisticated version of IRR, which I'll show you in this case. So let's say January 2008 to June 14, right? So he invested 10,000 rupees. So what I'm going to do is I'm going to put in minus 10,000 and I'm going to copy it for all the cells till June 14. Okay, so I think one extra has come in. Yeah, now it's 7,70,000. So in June 14 he's saying the value of the money was 15,40,000. So I'm going to put down 15,48,000. So that's my final amount. So why have I taken 10,000 as negative? Because that's an investment, and I'm saying I'm taking 15,48,000 as positive because at the end of the entire SIP calculation I am going to redeem this money. So this is going to come as a cash inflow. These are all cash outflow. So how can I calculate returns, right? So there's a concept of called as XIRR. Okay, so XIRR is just building on IRR. In case of IRR it does not consider the dates. In case of XIRR it will also consider the date, right? So along with selecting the values I also have to select the dates. So I selected the values, now I need to select the dates. So I selected the dates and now I close it. So you see I was able to find the return as 21.53% if you increase the decimal places. So XIRR is better than IRR because it also considers the dates. IRR will consider that everything is sequential and everything is happening month on month, right? So in case of XIRR, if I remove a certain date, right? So in case let's say I remove this, so my return changes, right? So that will make sure that it is considering the exact compounding dates.